Why do governments print currency for free and then pay interest to commercial banks to hold the same currency at the central bank? Two things are both true. A central bank can issue a new dollar, euro, or dirham at effectively zero production cost. A database entry, a reserve credit, an electronic ledger update. That difference between the face value of the money and the cost of producing it is called seigniorage. It has funded states for 3,000 years. But since 2008, every major central bank pays commercial banks interest to keep reserves parked at the central bank. The Federal Reserve pays interest on reserve balances. The European Central Bank pays the deposit facility rate. The Bank of England pays bank rate on reserves. As of mid-2026, those numbers are between 3 and 5%. The contradiction is intentional. Before 2008, the central bank controlled short-term rates by adjusting the quantity of reserves. Reserves were scarce. Banks competed for them. The rate found its level. After quantitative easing flooded the system, reserves became abundant. The old mechanism broke. The new mechanism is price. The central bank sets the floor, the rate paid on reserves, and the entire short-term curve aligns to it. Banks will not lend overnight below the rate they can earn for free at the central bank. For the operator, every basis point on that policy floor is paid out of taxpayer money to private banks. In 2024, the Fed paid over $200 billion in interest on reserve balances. That is a transfer, not a service. It happens to also be the central instrument of monetary policy. The two facts coexist.